Hello my intelligent friends, welcome to this lecture on accounting standard number 4, group 2, advanced accounting, CA intermediate. The subject is accounting standards and the topic is AS4, contingencies and events occurring after the balance sheet date. So let me now disappear from the screen and help you to concentrate on the subject. Now this topic is talking about two different concepts. One concept is contingencies and other concept is events occurring after balance sheet date. Let us try to understand both these concepts separately. What do we mean by contingencies? When AS4 is talking about contingencies, what does it talk about? So the meaning of the term contingencies as given by AS4 states that contingency is a condition or a situation, the ultimate outcome of which, gain or loss, will be known or determined only on the occurrence or non-occurrence of one or more uncertain future events. So the most important point which we all should be in a position to understand, that AS4 is clearly telling you it is a condition or a situation which is already present, but the outcome of the situation or outcome of the condition is not known at this moment. So the situation is present, but the outcome of the situation, whether it will be favorable or unfavorable, whether it will materialize or not, is not known just now. It is dependent on some uncertain future events. Then such a situation, such a condition will be called as contingency. So I am repeating again, the condition or the situation is already present, only its outcome is not yet known. Whether the outcome will materialize or not, that fact is not known to us, and if it materializes, at what amount it will materialize, that is also not known to us. So a condition or a situation is present, but how that situation, how that condition will materialize and when it will materialize is not known. Such a situation will be called as contingency. So what are the examples? For example, there is a debtor in the balance sheet and the debtor may become insolvent, and thereby the debt which is recoverable from him will become bad debt for the company. So this is a contingency. There is a debtor who may turn to be bad. So as on today, condition, existence of debtor is already there, but the future outcome, whether the debtor will pay the money or the debtor won't pay the money, that is not known. Or the business may have to pay for a court settlement. There may be a case which will be instituted by the rivals, or maybe by the employees, or maybe by competitors, or maybe by creditors, and the company or the business may have to pay in that court settlement. That is also a contingency. It may happen, may not happen. Business may buy a competitor, or business may get bought by a competitor, is also a contingency. Or the business assets may get destructed due to some natural calamity or maybe some man-made riots, etc. That is also a contingency. Does that mean that AS4 is going to talk about all these different types of contingencies, or only specific contingencies will be taken care of? Every contingency is considered by AS4, or only specific contingencies are considered by AS4? So which contingencies are covered? AS4 specifies that an event or a condition or a situation, the ultimate outcome of which may be resulting either in a gain or a loss, will be known only after happening or non-happening of a future uncertain event, is called as contingency. But all contingencies are not dealt with by AS4. Only an event which is in existence on the balance sheet date, but its outcome is contingent, is covered by AS4. If the event is not in existence on the balance sheet date, then it is not covered by AS4. So that is very important. If that event or that condition or that situation is not in existence on the date of balance sheet, then such an event is not covered by AS4. What do we mean by that? Let us consider one by one. If on the date of balance sheet, debtor has already suffered major setback and the chances of recovery of full or partial amount of his debt are limited, or a court case is already instituted against the business and the proceedings indicate that the business may lose the case, then these are the contingencies existing on the balance sheet date for the purpose of AS4. I have taken two different examples. Number one, there is a debtor in the balance sheet who has already suffered some major losses in his own business, and due to which probably we may not be in a position to recover full money due from him, or maybe part of the money will have to be foregone by us. So we already know that a debtor in the balance sheet has already suffered a setback, and we may not be in a position to recover either full or part of the amount. Then such a situation can be called as contingency for the purpose of AS4. Or before the balance sheet is finalized, a case is already instituted against the business, and the proceedings are going in such a manner that probably business is going to lose the case and we may have to settle the case. Today the court has not yet given judgment. Decision is not yet available. So we are not knowing what will be the decision of the court, how much will be the damages which will have to be paid. But one thing is sure, that some or other amount of damages may have to be paid. The court case is already started before the balance sheet date. It is already known to us that we may have to pay some amount of damages. How much will be the amount of damages will be dependent on the decision given by the court, which is a future uncertain event. Therefore, at present, the court case can be called as contingency. Now let us consider another example. If on the date of balance sheet, the debtor does not show any signs of insolvency. So there is a debtor and there is no sign of insolvency shown by him, or no cases are filed against the business. So up to the date of balance sheet, no cases are filed against the business, and on the balance sheet date, whoever are the debtors appearing in the balance sheet, none of them are showing the signs of any insolvency. Then the debtor is there who will materialize. There are no court cases as on balance sheet date. So afterwards somebody may file a case, that's a different story. Afterwards a debtor may become insolvent, that's a different story. But as on balance sheet date, we don't foresee any debtor becoming insolvent. As on balance sheet date, we don't have any cases against us. In that case, merely because somebody may file a case in future afterwards, merely because some debtors may turn out to be bad, some debtors may suffer setback in their business afterwards, due to which we may not be in a position to recover money from them afterwards. That is not a contingency will AS4 will consider. AS4 बोलता है whatever is a debtor in the balance sheet, if you already know that his amount may or may not be possible to be recovered fully, then it is a contingency. As on balance sheet date, debtors are of rupees 10 lakh and you don't see anybody of them becoming bad. In such a situation, there is no need to consider it as a contingency. But sir, afterwards it may so happen that out of 10 lakh we may recover only rupees 9 lakh and 1 lakh rupee debtor may become bad afterwards. As on 31st March, nobody is insolvent, but by 10th of April, one debtor suffered a big difficulty in his business, due to which 1 lakh rupees became irrecoverable. That is true. That is a different situation. We are talking about contingency. What is the meaning of contingency? An event, a situation, a condition which is already in existence on the balance sheet date. Only thing is its outcome is not certain. Then it is called as contingency for the purpose of AS4. The example which I gave you just now is the example where debtors of rupees 10 lakh are there in balance sheet and none of the debtors appear to be bad. In such a situation, there is no condition which is present in the balance sheet which appears to be uncertain. Everything appears to be certain. In such a situation, it will not be called as contingency for the purpose of AS4. If in such case, after the balance sheet date but before the financial statements are approved, so afterwards, that is 31st March, balance sheet is prepared, financial statements will be approved by the board of directors, maybe on 30th April, maybe on 31st of May, maybe on 30th of June. So from the 31st of March, that is the date of balance sheet, to 30th of June, that is the date of approval of the financial statements by the board of directors, in between 3 months are there, and in those 3 months some debtors become insolvent. As on balance sheet, we were not thinking of any of them becoming insolvent, but in those 3 months one of them have become insolvent, thereby he turns out to be bad debt. Or in those 3 months a case is filed against the business where the business may lose the case. Then also the situation will not be covered as contingency, because contingency means a situation which should prevail on the balance sheet date. On the balance sheet date, none of the debtors were appearing to be bad. On the balance sheet date, no cases were filed, merely because after the balance sheet date but before the financial statements are approved by the board of directors, in those 3 months period, some debtors have turned out to be bad. In those 3 months, some cases are instituted against the company. Automatically these things don't become contingencies. For a particular thing to be classified as contingency, it is necessary that such contingency should already have been in existence in the balance sheet on the date of balance sheet. So of the debtors of 10 lakh as on 31st March, we were already aware that one debtor of 1 lakh may not realize, may or may not realize. So now it becomes a contingency, because on balance sheet date we already know that somebody is either going to pay or may not pay on account of a future uncertain event. Then it will become contingency. On 31st of March, of the debtors of rupees 10 lakh, if we are aware that all of them may be paying, there is no problem, and afterwards on account of some natural calamity one of the debtor ultimately turned out to be bad, that is okay, it doesn't become a contingency. It may be treated as an event occurring after balance sheet date for AS4, but it will not be treated as contingency. Now what does this sentence mean which is given in the bracket? I'll be discussing it separately when I'll be talking about events occurring after balance sheet date. At this moment I'm talking about contingency. The thing to be kept in mind is that if this position was not in existence on balance sheet date, then merely because it happened after the balance sheet date but before the financial statements are approved by the board of directors, automatically it does not become contingency. To become a contingency, the position should have been in existence on the balance sheet date, only its outcome was uncertain. Last situation, in case of sundry debtors, some of them turning out to be bad, or ultimately some portion of their debt may become irrecoverable, it may be considered as a contingency based on the previous experience of the business. So we are already aware that of the total debtors, generally 5% become to be bad. Who will become bad, that is not known to us, but generally we are going to say that 5% will become our bad debts. In such a case, creating a provision for bad debt as a percentage of total debtors, then you are not identifying individual debtor who is going to become bad, but you are considering a general provision of 5% on all the debtors. That is also advisable, because you are aware that generally whatever is the amount of debt we are having in a balance sheet, out of which 5%, 10%, 15% are the bad debts which are suffered by any business who is doing our type of activity. So it is better for you also to create 5%, 10% or 15% RDD. That is also acceptable. So if you know a particular debtor is going to turn out to be bad, then you are going to create a contingency provision for the same. Or if you are not identifying any specific debtor as such, but your general business knowledge tells you that of the total debtors which happen in your business, out of that 5% or 10% are generally going to be bad, then whatever is the amount of debtors in the balance sheet, on that you can create a provision of 5% or 10% depending upon your business knowledge. That will also be considered as contingency. So we have basically discussed what is the meaning of contingency and which type of contingencies are covered by AS4. Let us now consider the basic rule of contingency. If the contingency is existing on the date of balance sheet, then the effect of the same should be given in the financial statements on estimation basis. So if you are already aware that there is a condition, the outcome of which is uncertain, then it is better for you to estimate the outcome and account for the same in the financial statements. Be careful, the wording is the same should be given, effect of the same should be given in the financial statements. That means you are going to pass an actual accounting entry for the same. You are not going to write just a note as a footnote or maybe some disclosure requirement. It is an accounting entry that you are going to pass for contingency. It should be noted that effect of contingency is shown in the financial statements on estimation basis. So we have just now discussed that if you know that there is a contingency, the outcome of which is uncertain, then the management is expected to make the estimation of that contingency and record that estimation by way of an accounting entry. A simple example is RDD. How do you create RDD? You pass the entry profit and loss account debit to RDD account. What is that? That's an accounting effect of the contingency given in the financial statements on estimation basis. So how do we give the effect? Effect is given on estimation basis. However, it does not mean every accounting entry which is based on estimation will automatically amount to contingency. Contingency recording happens on the basis of estimation, but it does not mean every recording which happens on the basis of estimation automatically becomes contingency. For example, depreciation. Amount of depreciation either on SLM or on RBM is basically an estimation basis. Or you create provision for expenses, provision for electricity bill, or maybe provision for salary for the last month. Then all these different provisions are basically estimations. But although they are estimations, they are not contingencies because they are certain transactions. You are already knowing. And in fact, the amount of electricity bill which may be paid in the month of April in relation to the month of March is also generally known to you, because before you prepare your finalization, you are already having the electricity bill. You already know what is the amount of salary which will have to be paid. The accurate amount of estimate is possible in relation to those things. Depreciation, although it is an estimation, but it is not a contingent thing. Whether depreciation will happen or not, that is not known to us. This is not a situation. Depreciation is happening. So it is not called as contingency. I am repeating again, contingency must be recorded. Recording should be done on estimation basis. In other words, contingency is recorded on estimation basis, but it does not mean everything what is recorded on estimation basis automatically becomes contingency. To become contingency, number one, the event or the condition or situation should be present. Only its outcome is uncertain. Depreciation is not uncertain. Depreciation is happening. Provision for salary, provision for electricity bill for the month of March is not uncertain. It is happening. We already know. We have consumed the services of our employees. We have already taken the services of MSEB, that is electricity board. That means we will have to pay. So it is not contingent. We may pay, we may not pay. That is not the case. We will pay. So depreciation or provision for expenses which are recorded by us in the P&L account in the financial statements on estimation basis, they do not become contingency. For contingency, event is already there, outcome is uncertain. Therefore, the uncertain outcome is recorded by the management by using estimation. That is called as contingency. Next, if such estimation is not possible, sometimes it may so happen that it is not possible for you to do the estimation properly, then the fact of existence of and nature of the contingency, that there is a contingency, it exists and its nature is so and so, will have to be disclosed separately in the financial statements by way of a note. I am repeating again, if there is a contingency, estimate the same and give the effect of that estimation in the financial statement itself. That means pass the accounting entry. Second, if there is an contingency which is in existence but it is impossible for you to make the estimation, then you cannot pass the accounting entry now, because for passing an accounting entry you must have the amount and estimation is not possible. So what will you do? You can't pass the entry now. Then below the financial statements write a note which will enable the reader, which will enable the user of financial statements to understand what is the nature of contingency and the existence of contingency. This is expected by AS4. So let me consider the rules again. These are the basic rules. Let us classify the rules now according to different situation. If there is a contingency which is resulting in gains, then what should we do? There is a contingency which may result in gain. We may win a court case. We may win a court case. It's a contingency, and it's a contingency which is going to result in gain. Then should we record it? Should we count the estimation for the same? No. A contingent event which may ultimately result in gain, such contingent gains are not recorded in financial statements. This is anyway the concept of prudence, which is already taught to us for many number of times. So prudence demands that contingent gains are not to be recorded. So contingent events should be recorded, but if the contingent events are going to result in gains, then such gains need not be estimated and such estimated gains need not be accounted. They need not be disclosed. It is contingency which is going to suffer or result into losses. Contingency which is going to result into negative position, that is required to be recorded. So contingency is resulting in losses, and if the estimation is possible, then what we are going to do? Then contingent event may ultimately result in loss. Such contingent losses are to be recorded in financial statements on the basis of estimation made by the management on its own or with the help of expert. Sometimes the estimation may be done by the management on its own, or sometimes management may take the help of an expert to understand what may be the estimated amount of contingent losses which may be suffered by the company on account of a particular event which is already in existence in the balance sheet, but its outcome is not known. So management may make its own estimation, and if the management thinks that it is better for them to take the help of somebody else, then they may take the help of expert. Now what is the date of estimation? If there is a contingent event on the date of balance sheet, then we are required to pass the accounting entry for the same. Then the accounting entry is going to be passed on the basis of estimation made by management either on its own or with the help of expert. Then the estimation should be done by the management on which date? On the date of balance sheet or on some other date, then the date of estimation should be date of approval of financial statements and not on the date of balance sheet. Be careful. So on 31st March you are having debtors in your balance sheet. Of that you are of the opinion that some debtors may turn out to be bad. Then what will be the amount of contingency provision created in relation to such probable bad debts? That contingency provision need not be based on 31st March. That contingency provision will be based on the information available on the date of approval of financial statements. So the financial statements are going to be approved by the board of directors maybe on 30th of June. Then as on 30th June, whatever information is available to you in relation to those debtors, that information should be used to decide the amount of RDD. As on 31st March, you are thinking that okay, probably we may be getting 50% recovery from this debtor. But by 30th June, you are of the opinion that no, it is impossible to recover now 50%. We can recover only 25%, 75% may have to be written off. Then the provision which is to be made in the financial statement should not be 50% which was estimated on 31st March, but it should be 75% is provision which is estimated on 30th June. So I'm repeating again. If the contingency is resulting in gain, then don't record the same. If the contingency is resulting in losses and estimation is possible, then please do the estimation either by the management itself or with the help of expert. And the estimation should not be based on the information available on the date of balance sheet, but estimation should be based on the information which is available on the date of approval of financial statements. Okay. And then comes the last point. Contingency resulting in losses and estimation is impossible. So this is the situation where it was resulting in losses and estimation was possible, and now the situation is contingency resulting in losses but estimation is impossible. If the contingent event, if it is resulting in loss but there is a conflicting or insufficient evidence for estimating the amount of loss, then such contingent loss cannot be accounted for in the books, because for accounting you need to have estimation. In such a case, a disclosure should be made by way of a note in the financial statements. By way of a note in the financial statements. Be careful. By way of a note in the report 9. By way of a note in the financial statement. So below the P&L account, below the balance sheet, you are going to write the notes to the accounts where you are going to specify that there is an existence of a contingency of so and so nature and the management is not in a position to estimate the amount of the same. So once the reader is aware that he is looking at a P&L account, he is looking at a balance sheet which is without considering a contingency, and the contingency is of so and so nature, then he will be in a position to form his own opinion about the financial statements in a more proper manner. So it's the duty of the accountant now to follow these different rules in relation to contingency. Repeating for the last time, if the contingency is resulting in gain, ignore the same. If the contingency is resulting in losses and estimation is possible, then the estimation can be done by the management on its own or with the help of expert, and based on that estimated amount, accounting entry will have to be passed in the financial statement itself. For the purpose of estimation, the information available on the date of balance sheet need not be taken as the basis. In fact, the information which is available on the date of approval of financial statements, that is to be taken as basis. So on the date of balance sheet, if you are of the opinion that bad debt may be only 50%, but by the date of approval of financial statements by the board of directors, you are having the information which is telling you that the debtors which are identified by you to be problematic are not going to give you 50% of their total debt, but are going to give you only 25% of their total debt. That means remaining 75% is going to turn out to be bad. So on 31st March, your estimation was 50% is bad, but on 30th June, when the board of directors are approving the financial statements, your estimation is 75% is going to be bad. Then the contingency entry which you are going to pass in the financial statement should be for 75% bad debt, not 50% bad debt. And last situation, if you are facing a contingency which is there in the balance sheet on the date of balance sheet, and you are trying to identify the estimated amount of the same, but it is impossible for you to calculate the estimated amount, or there are conflicting information which is available. In such a situation, it is not possible for you to pass the accounting entry. Then below the financial statements, you are supposed to write a note telling the user that there is a contingency in existence and the nature of the contingency so and so. The amount is not possible to be disclosed, or amount is not possible to be estimated. These are the rules in relation to contingency told by accounting standard number 4. Now that takes us to the second part of accounting standard, which tells us events occurring after the balance sheet date. Now what do we mean by events occurring after balance sheet date? Events occurring after balance sheet date are those significant events, both favorable and unfavorable, that occur between the balance sheet date and the date on which the financial statements are approved by the board of directors in case of a company, and by the corresponding approving authority in case of any other entity. So after 31st March, but before the date of approval of financial statements by the board of directors, whatever events take place, those events are considered as events occurring after balance sheet date by AS4. I am repeating again, AS4 is not specifying that every event which is happening after 31st March automatically becomes event occurring after balance sheet date. But an event or all those events which took place after the date of balance sheet but before the date of approval of financial statements by the approving authority. Who is the approving authority? In case of company, it is board of directors. In case of partnership firm, it is obviously the partners. So whoever is the approving authority, it is approving the financial statements on a particular date. So all the events which took place from the date of balance sheet up to the date of approval by the approving authority. Approving authority does not mean government authority. Approving authority means the authority which is going to sign on the financial statements stating that these financial statements are accepted by us, and then they will be given to the auditors for the purpose of checking. That is the date which we are going to consider. So for example, year ending 31st of March 2021, financial statements are finalized and approved by the board of directors of the company in its meeting held on 4th of September 2021. In this case, the events which are taking place from 1st April, that is after the balance sheet date, up to 4th of September, because that is the date on which board of directors approved the same, are termed as events occurring after the balance sheet date. All those events which are happening after 4th of September are automatically outside the purview of AS4. They are not the events which are required to be considered for AS4. The events which are taking prior to 31st March, taking place prior to 31st March, are anyway events taking during the financial year. Anyway, events which are happening during the financial year. Those events which are happening after 31st March but before the date of approval of financial statement by the board of directors or by the approving authority, such events, although they are happening after the balance sheet date, probably we may have to record them in the balance sheet. Probably, there is no guarantee. There are certain rules which are to be recorded, which are not to be recorded. But these events, although they are after balance sheet date, we may have to give effect of them in the balance sheet. And all those events which are after the date of approval of financial statements are automatically out of this situation. They will be accounted for obviously in the next accounting year, because they are happening after the, not only after the balance sheet date, but also after the date of approval of financial statements by the board of directors. So I hope it is clear now. Two dates are important. Number one, the date of balance sheet, and number two, the date of approval of financial statement by the approving authority. Whatever events take place between these two dates, are called as events occurring after balance sheet date. So these are different from contingencies, because contingencies are those things which are already in existence on balance sheet date. They are already in existence on balance sheet date and only their outcome was not known. Whereas here we are talking about those events which didn't happen on the balance sheet date. They happened after the balance sheet date but before the date of approval of financial statements by the board of directors or by the approving authority. So this is the second part of AS4. Let us now consider what are the different types of events which are considered by AS4. Events occurring after the balance sheet date can be classified in following two categories. Number one, adjusting events, and number two are non-adjusting events. Adjusting events are those which provide further evidence of conditions that existed at the balance sheet date. For example, a trade receivable declared insolvent after reporting date and unable to pay full amount, against whom provision for a doubtful debt was created. So we already had created our RDD against a particular debtor. We were already thinking that probably he may become bad, and afterwards he has actually turned out to be fully bad. Then this can be called as an adjusting event. We were already aware that probably some difficulty might take place, and now the difficulty has actually taken place. So let us consider three different cases now. If a debtor of rupees 5 lakh had suffered a setback in his business before the balance sheet date, so before we preparing our balance sheet, before 31st March, there is one debtor in our balance sheet of rupees 5 lakh, who has already suffered a big setback in his own business, and the management of our business has estimated that only 50% may be recovered from him. So out of 5 lakh, we may be in a position to recover rupees 2,50,000. Then a provision of rupees 2,50,000 is already made by the management by using the principles of contingency as explained earlier, because management is of the opinion that we are probably going to recover only 50% of the money from him. So remaining 50% is bad debt. That is an estimation of the management, and accordingly entry is already passed. P&L account to RDD account 2,50,000. Now if after the balance sheet date but before the date of approval of financial statements, there is no transaction of recovery or write-off against the said debtor, then there are no adjusting event in relation to this debtor. So I'm repeating again, after 31st March, on 31st March, you are knowing that there is a debtor of rupees 5 lakh who probably may become bad. So you are telling the management that let us make an estimation of the bad debt which may happen. So management has decided that probably we will be in a position to recover 50% of the money from this debtor. Remaining 2,50,000 we may not be in a position to recover. So management has given a permission to the accountant to pass the entry for RDD to the extent of rupees 2,50,000. This is the entry on the basis of contingency. Thereafter 31st March is over, and let us say 4th September is the date of approval of financial statements by the board of directors. So from 31st March up to 4th of September, from that debtor we neither recovered anything nor we wrote off anything. The debtor's account is still pending. In that case, there are no events occurring after the balance sheet date in relation to such debtor. Only contingency was recorded, but no events occurring after balance sheet date happened in relation to those debtors or that particular debtor. And let us consider third situation. If after the balance sheet date but before the date of approval of financial statement, matlab before 4th of September, if it so happens that the debtor is declared insolvent and ultimately we could recover only rupees 1 lakh from his estate. So we were having a debt of rupees 5 lakh against which we had already created a provision of rupees 2,50,000. So from our understanding, we were of the opinion that probably we will be recovering 2,50,000, but before the balance sheet or the financial statements are approved by the board of directors, that debtor has declared his insolvency and we could recover only rupees 1 lakh from his estate. Then whatever amount which was already provided for by the board of directors by using information available on 31st March or maybe on 30th June, etc., that is 2,50,000 is to be recorded as bad debt or 2,50,000 is to be credited as provision. That information has gone wrong. In reality, we have suffered a total bad debt of rupees 4 lakh because we could recover only rupees 1 lakh. So 2,50,000 is already written off by us, and event occurring after balance sheet date has taken place. What is the event? The debtor has declared his insolvency. This event did not happen before 31st March. This event happened after 31st March. So it has happened after the accounting year has ended. That means actually speaking, it need not be considered in the balance sheet. It should be considered as a loss of the next accounting year. Additional loss of 1,50,000 should be considered as the loss of next accounting year. But AS4 tells you that this particular insolvency as declared by the debtor is before the approval of financial statements by the board of directors. So you have created a provision for bad and doubtful debts of rupees 2,50,000 in the financial statements on the basis of estimation of contingency. That is a good thing, not a problem. But now one more thing has happened. Not only the contingency is recorded by us, but before the financial statements are getting approved by the board of directors, you are having an event which took place after the balance sheet date, and the definition of balance sheet after balance sheet date is from the date of balance sheet up to the date of approval. Within that period, additional information came to your knowledge which is telling you that your provision is insufficient. You need to create additional provision of 1,50,000. Then what will happen? The earlier provision of 2,50,000 accounted on the basis of estimation by the management is falling short due to recovery of only rupees 1 lakh. It means the adjustment of rupees 1,50,000 in financial statement is required, since the event occurring after balance sheet date has provided further evidence of the conditions that existed at the balance sheet date. On the balance sheet date, there was a debtor of rupees 5 lakh, which we were thinking that we will be in a position to recover rupees 2,50,000, but in reality our balance sheet was not our position was not that strong. the security which we were having against that debtor was very weak, or probably we were already unsecured creditor for that particular person and his estate was inflated. This was not known to us. When liquidator actually did the work, we ultimately came to know that although we were thinking of recovering 2,50,000, we could recover only rupees 1 lakh. So this is an additional information which was already there in existence on balance sheet. It was not known to us, but after the liquidator gave us the final amount, we came to know, okay, this is the final amount. So this becomes an adjusting event. So we will have to consider not only 2,50,000 as was recorded by us as contingency, but we will have to also consider 1,50,000 additional loss, although the loss happened maybe in the month of August before 4th of September. Sir, but the loss has happened after 31st March. That means it has happened in the next accounting year. So it should be recorded as a loss of next accounting year. Yes, what you are saying is true. But AS4 tells you that it's an event which is occurring after the balance sheet date, and it's an adjusting event because it's an event which provides further evidence of the conditions that existed at the balance sheet date. Therefore, we will have to record this 1,50,000 ka loss, which we probably realized in the month of August when liquidator gave us only rupees 1 lakh. This 1,50,000 ka loss, although suffered in the month of August, matlab next accounting year, should be recorded in the balance sheet, should be recorded in the P&L account, which was closed on 31st March itself. So this is called an adjusting event, an event which took place after balance sheet but which should be adjusted in balance sheet. An event which took place after P&L account is closed, but it should be recorded in the P&L account which is already closed. That's why it is called an adjusting event. It is going to adjust the P&L account, it is going to adjust the balance sheet. And second type of events are non-adjusting events. That means these events are happening after the balance sheet date and before maybe the date of approval by the board of directors. So they are within that time period, but they are of such nature that they are not going to change the financial position as on the date of balance sheet. Therefore, we will not be changing the items of P&L account and balance sheet. These are those items which are indicative of conditions that arose subsequent to the balance sheet date. They are the events which were never in existence on the balance sheet date. They happened only after balance sheet. Therefore, there is no need to record them in the balance sheet. For example, a plant got damaged due to occurrence of fire in the month of August. 31st March balance sheet is closed. In the balance sheet there is plant and machinery on 31st March. In the month of August there was a huge fire in the factory due to which plant got destroyed, and then 4th of September your board of directors are approving the financial statements. On 4th of September they are looking at a balance sheet. The balance sheet is prepared for 31st March. Accordingly, in the balance sheet there appears to be plant and machinery, but in reality they know that the plant and machinery is of the value 0. It is already totally burnt off, disposed of, destroyed by fire. So in reality there is no plant and machinery, but in balance sheet there was plant and machinery. Now they may specify that just like the earlier situation where you had written off bad debt of rupees 2,50,000, but you are also required to write off additional bad debt of rupees 1,50,000, and you came to know about the bad debt after the balance sheet before we approving the financial statement. So you recorded 1,50,000 additional bad debt earlier. Similarly, if you have suffered a loss of damage to plant and machinery, then let us write off plant and machinery in balance sheet itself. Then AS4 will come into picture and will tell you, sorry, as on 31st March there was no indication that the plant and machinery will catch fire. This is a complete accident. This is not something which was a condition which was already prevailing on 31st March and afterwards only realized by you now. That is not the case. This condition of plant and machinery catching fire was impossible to be envisaged, impossible to be thought of on 31st March. It was never in existence on 31st March. Therefore, this need not be adjusted on 31st March. So it's an event which happened in August. So two events happened in August. Let us say a debtor of whose total debt of rupees 5 lakh we had already written off rupees 2,50,000, became insolvent or declared insolvency and paid us only rupees 1 lakh. So we were required to write off additional rupees 1,50,000. This additional loss of 1,50,000 which happened in the month of August, that means after 31st March, will still be recorded in the balance sheet up to 31st March, in the P&L account up to 31st March. But in the same month of August, our company also suffered a huge fire in our factory, due to which our plant and machinery got destroyed, and there is a loss of plant and machinery, but it will not be adjusted in balance sheet, it will not be debited to P&L account because it's a non-adjusting event. I hope it is clear to all of you. Now let us consider different examples for the same. First example is loss of trade receivable account which is confirmed by the insolvency of customer which occurs after the balance sheet date. So what has happened? There is a trade debtor, receivable, who has confirmed of insolvency. The insolvency occurred after the balance sheet date, but the debtor was already there and we were already aware that he may become bad. So this becomes which type of event? Adjusting event. This is not a non-adjusting event. This is an adjusting event. Principle कुठला त्याचं? What is the principle? Adjustments to assets and liabilities are required for events occurring after the balance sheet date that provide additional information materially affecting the determination of amount relating to the conditions existing at the balance sheet date. So what is the treatment we are going to give? So give effect to the bad debt in the financial statements, although the bad debt has occurred after the balance sheet date. We have already taken the example of the same. Second example, now as on 31st March we are having some investments in balance sheet. And on 4th September the board of directors are going to approve the financial statements. By that time those investments have fallen their value in the share market. So there is a decline in the market value of investment between the balance sheet date and the date on which the financial statements are approved. Then what type of event it is? Should we say let us write off the investments just like we wrote off the bad debts? Should we say let us write off the investments? No. This is a non-adjusting and non-statutory obligation. This is a non-adjusting and non-statutory obligation. This extra word not is not required. I'll remove it separately. Non-adjusting, non-statutory obligation, and it is not affecting the going concern assumption of the company, and it is not of some significance also. Adjustment to assets and liabilities are not appropriate for events occurring after the balance sheet date if such events do not relate to the conditions existing on the balance sheet date. As on the balance sheet date, the market value of the shares was high. Afterwards it has fallen down. That does not change the fact that on the balance sheet date the market value of the investments was higher. So ordinary fluctuations in the market value do not normally relate to the conditions of the investments at the balance sheet date, but they reflect circumstances which have occurred in the following period. So what we should do, don't give effect in the financial statement to the decline in the market value of the investments after the balance sheet date, and no need of any disclosure, let it be. The reader of financial statement will think that okay, as on 31st March market value was rupees so and so, more than sufficient. Today's market value is lower, that is okay. But as on 31st March this was the balance sheet value, or this was the value of investment. By disclosing that information of the value on 31st March only, not recording the value on 4th September, you are not deceiving the reader of the financial statements, because changes in the value of investment is an ordinary situation. Today's reduction in the value does not have any bearing on the value of the investment on balance sheet date. So there is no need for you to change the balance sheet date. Whereas actual loss of bad debt is actually changing the position of balance sheet date. These investments which are still holding in our hands, we are not selling them. So there is no need for us to worry about the same. Okay. Next event we are considering is events occurring after the balance sheet date which do not affect the figures stated in the financial statements but are significant to affect the opinion of the user about the business. So there are some events which are happening after 31st March but before 4th of September, but they are not changing the position of a particular item which was in existence on 31st March, but they are significant. Then what we should do? That means they are non-adjusting events basically, because they are not changing the position of a particular item which was there on 31st March. Plus there is no statutory obligation also about the same. Plus they are not affecting the going concern like some destruction of plant and machinery or something of that sort, but they are significant. Or maybe there is a destruction of one plant. Let us say there is a big company which is having plants at multiple different locations, and one of the location they have suffered huge fire, due to which the plant machinery there is destroyed, but rest of the locations are still going on. So this particular event which took place of fire at a particular factory, out of the 10 different factories all over India, in one of the factory there was fire. It has not affected the business completely, but yes, it is a significant information. Reader should be aware that in the balance sheet, although there appears to be plant and machinery at 10 different factory locations, when he is reading the financial information, at that time one of the factory has suffered huge damage due to fire. So this information he should be aware, but it does not mean that as on 31st March we should change the value of balance sheet, value of plant and machinery in the balance sheet. So the principle is such events would not normally require disclosure in the financial statements. Be careful, they need not require any disclosure in the financial statements, so no need to prepare any loss by fire account in P&L account, and there is no need to show reduction from the plant and machinery on the balance sheet asset side. Although they may be of such significance that they may require a disclosure in the report of the approving authority. So there is no disclosure in balance sheet, there is no disclosure in P&L account, but the report of the approving authority, maybe the director's report. The director's report will specify. Nothing is in P&L account debit side, nothing is in balance sheet, nothing is by way of a note to the P&L account or note to the balance sheet. But the director's report, which is also given to the shareholders, there it will be mentioned that one of the factory has suffered damages due to fire. So I'm repeating again, what is the specialty of this event? Number one, it is not changing the position of any item which was in existence on balance sheet on that particular date, on balance sheet date. Afterwards it has changed, but on balance sheet date there was no knowledge to us that such an event will take place. So on the balance sheet date, 10 factories, 10 plant and machinery, good. By the time of approval, out of those 10 factories, 10 plant and machinery, one of them has got destructed. But our balance sheet will still show 10 plant and machinery. P&L account will still show depreciation on 10 plant and machinery. No effect of loss by fire in P&L account or in balance sheet. No note to the P&L account, no note to the balance sheet. But in the director's report, you will make a note about the same, disclosure about the same, that one of the factory was destructed by fire. So don't give effect in the financial statements, but give disclosure in the report of the approving authority. This is a very important thing which will have to be kept by you in mind when you are answering theory questions. Next point is dividend declared after the balance sheet date but before the financial statements are approved. Then type of event is, this is obviously not adjusting, but it is a statutory obligation, because on the date of balance sheet there was no liability. After the balance sheet, the liability has got created. And now once the dividend is declared, within 45 days you will have to pay. You already know the conditions of declaration of dividend. What are the requirements within 7 days, within 45 days, and then how it is required to be transferred to Investor Awareness and Protection Fund. So that is a statutory liability. Once it is declared, thereafter you don't have the capacity to control that situation. So it is an event which took place after the balance sheet date, before the date of approval from the board of directors. But it is a statutory obligation which is created. Then there are events, although they take place after the balance sheet date, are sometimes reflected in the financial statements because of the statutory requirements or because of their special nature. So what should we do? The treatment is, dividends are not to be recognized as a liability in the balance sheet date because no obligation exists on that particular date, but such dividends are disclosed in the notes to financial statement. So I hope you have seen how you prepare your financial company final accounts topic. In company final accounts, whenever there is a proposed dividend is shown by way of a note. It is not shown as debit to P&L account. It is not shown as a current liability, but it is shown by way of a note. Reason is accounting standard number 4 has told us that it will have to be considered like this. It's a non-adjusting liability because as on 31st March there was no liability. Afterwards there is a liability. But this liability does not change the position of assets and liabilities on the date of balance sheet, but it is necessary to be disclosed now because it's a statutory liability. So how it is to be disclosed? Not in the financial statement, not in the report of the approving authority, but by way of a note to the financial statement itself. The earlier one, gray event, it was disclosure in the report of the approving authority, and statutory obligation rahega to it is by way of a note in the financial statement. Okay. Now comes the last point, destruction of a major production plant by fire after the balance sheet date. Now I am taking the example to a higher level. Out of 10 different plants, maybe only one plant survived and 9 plants have suffered damage. That means now actually speaking, probably the company's position to run as a going concern itself is affected. Company's position to run as a going concern itself is affected. Then this is a type of event which is basically non-adjusting, because on the balance sheet date there were 10 plants. On the balance sheet date there were 10 factories. Afterwards 9 factories are destroyed, and due to which it is not just a significant event, but it is also the having the capacity probably of changing the assumption that the company may work. Probably the company may have to be liquidated now. There is no capacity to the company to continue. So the going concern assumption itself is getting affected. Then the principle states that events occurring after the balance sheet date may indicate that the enterprise ceases to be a going concern. Sometimes it may so happen that those events which took place after the balance sheet date but before the approval from the board of directors, some events took place which are actually directly damaging the capacity of the company to work as a going concern. A deterioration in the operating results and the financial position, or unusual changes affecting the existence or substratum of the enterprise, may indicate a need to consider whether it is proper to use the fundamental accounting assumption of going concern in preparation of financial statement. So there is a question mark. Will the company survive? And probably no. In that case, it is better for you not to prepare your financial statements by using the going concern assumption, but to prepare the financial statement on liquidation basis. That means what will be the realizable value of different assets and liabilities. In such a situation, going concern assumption is not valid. Therefore, the financial statements are prepared on liquidation basis. So there is no need to disclose something in the financial statements by way of a note. There is no need to disclose something by way of only director's report. There is no need to make any single entry or something like that. By default, you are going to prepare all your P&L account, balance sheet, everything by removing the going concern assumption. That means everything will be recorded at their today's market value basis, because you are going to liquidate the company. So the fundamental accounting assumption itself will change. Accordingly, the P&L account and balance sheet preparation strategy will change. Okay, so these are the basic requirements of contingencies and events occurring after balance sheet date. Disclosure requirements. What are the disclosure requirements of the events occurring after balance sheet date? Number one, when you are disclosing it, you will have to disclose the nature of the same and the estimate of the financial effect that will have to be shown. And if you cannot make the estimate, then give a note that it is impossible to make the estimate. So number one, nature of the event will have to be told. Number two, if possible, give the estimate of the financial impact of such event occurring after balance sheet date. And if it is not possible to give the impact of financial impact of that event, then give the statement that so and so event took place and it is difficult for us to estimate the financial impact of the same. So these two different things are required to be mentioned. Repeating again, what happened and what is the financial impact, or what happened and the fact that you cannot ascertain the financial impact. These two things will have to be mentioned. Okay, so here we complete the basics of AS4. Let us now consider some examples which will help you to again understand how the questions may be asked in the exam and how they are supposed to be solved. So first question is, a company follows April to March as financial year. The company recognizes checks dated on 31st March or before received from the customers after balance sheet date. So let us say you are receiving a check from the customer on 2nd April. But the check received from the customer is of 31st March or maybe 30th March. The customer is very intelligent customer. He is giving you the date of 30th March, but it is given to you on 2nd April. Now the accountant of the company is thinking that although the check is received on 2nd April, since the check is dated 30th March, since the check is dated 25th March, that means it is before the balance sheet date. Okay. The accountant is debiting their checks in hand account. On 2nd April, the check is received, but the accountant is recording the check as if it is received on 25th March itself and is debiting the checks in hand account and crediting the debtors account. The checks in hand are shown in the balance sheet as an item of cash or cash equivalent. So those 25th March check, 30th March check, 31st March checks, which are received probably on 2nd April or maybe on 5th April. But since they are having a date prior to 31st March, this accountant has recorded them as if they are received before 31st March, and accordingly in the balance sheet he is showing checks in hand account and he is showing reduction in debtors account. Thereafter he is depositing the checks in the bank in the month of April, and everything is realized also in same month. Fortunately, the checks which are received on 2nd April or 5th April, which were having a date of 25th March or 30th March or 28th March or 31st March, are thereafter deposited by the accountant in the bank, and the bank collected the check and everything is realized, let us say, by 10th April. So the accountant is thinking that probably I have done everything properly. I have not done anything wrong. On 2nd April I received the check, so I should have passed the entry on 2nd April, bank account debit to debtors account. Instead, I have passed the entry on 31st March itself, bank account debit to debtors account. Thereby, in the balance sheet, bank account or checks account is appearing as if it's an asset, and debtors account is getting reduced as if the money has paid by the debtor before 31st March. In reality, debtor has paid the money, but the debtor has given the check on 2nd April, which got cleared on 10th of April. Only thing is that on 2nd of April, when the check is given by the debtor, at that time the date on the check written by the debtor is 25th March or 31st March. Therefore, the accountant, instead of using the date of receipt, he is using the date of check to pass the accounting entry. And accounting entry is passed as if it is received on 25th March. So on 31st March, checks are there. That is what he is saying. In reality, on 31st March, there were no checks. Checks came on 2nd April. And afterwards, all these checks got cleared. So accountant is saying, sir, kya farak padta hai? It is okay na. My accounting is correct. So the question is this accounting treatment correct or not? Think about it. How to think about it? You can pause the video, think about it, and then look into the answer. Even if the checks bear the date of 31st March or before, the checks received after 31st March do not represent any condition existing on 31st March. Thus, the collection of checks after the balance sheet date is not an adjusting event. As on 31st March, the debtors were pending. Merely because afterwards we collected money, it does not mean as on 31st March debtors were realized. So this is not an adjusting event. This is non-adjusting event. Recognition of check in hand is therefore not consistent with the requirement of AS4. Moreover, collection of checks after the balance sheet date does not represent any material change or commitments affecting the financial position of the enterprise. So no disclosure of such collection in the director's report is necessary. Now accountant is saying, okay sir, you are telling me that I have made a mistake by recording the checks. I should not have done it. Okay, then should I write it in the director's report that afterwards the checks are collected on 2nd April? No, there is no need to show any disclosure in director's report about collection of checks, because it is not some significant thing. It is a natural thing that you sell the goods to the customers on credit, customers pay you the money. This is a normal course of business. This is not some significant aberration from the business. So there is no need to disclose it in the director's report also. First one, your accounting is wrong. Whatever is received on 2nd April should be recorded on 2nd April. Merely because what is received on 2nd April bears a date of 25th of March does not mean that the transaction took place on 25th of March. Transaction took place on 2nd April itself. It is not an event which is required to be considered as an adjusting event. It does not change the position on 31st March. On 31st March, the person was debtor and afterwards he paid, but afterwards he paid. It does not mean on 31st March he ceased to be a debtor. On 31st March he was a debtor. So your accounting is wrong. Check account should not be debited. Debtors account should not be credited. And there is no need to disclose anything in director's report. It should also be noted that the framework for preparation and presentation of financial statement defines assets as resources controlled by an enterprise as a result of past events from which economic benefits are expected to flow to the enterprise. Since the company acquires custody of the checks after 31st March, it does not have any control over the checks as on 31st March, and hence checks in hand do not qualify to be recognized as an asset on 31st March. So on 31st March you should not have created checks in hand account. On 31st March you should not have credited debtors account. Debtors account should have been higher and checks in hand account should not have been there. So this is the treatment which will have to be given. If the accountant is doing extraordinary intelligence, we are required to tell him how accounting standard number 4 is required to be interpreted. If you want, take a break, stop the video and then start it again. Okay, let me go for the second example now. In X Company Limited, theft of cash of rupees 5 lakh by the cashier in January 2021 was detected. So the theft of cash took place in January 21, but it was detected only in May 21. So theft took place in January, but it was noticed, it was detected in May. The accounts of the company were not yet approved by the board of directors of the company. So now try to understand, your financial statements are prepared from April to March. Before March, in the month of January, theft of 5 lakh rupees took place. As on 31st March, it was not known. Afterwards, in the month of May, it was understood that there was a theft. When the theft was detected, at that time, the board of directors have not yet approved the financial statements. Now the question is whether the theft of cash has to be adjusted in the accounts of the company for the year ended 31st March 2021. You are required to decide for the same. Beautiful question. Theft which took place before 31st March but was remaining undetected as on 31st March got detected after 31st March, that is in the month of May, but got detected before the statements are approved by the by the approving authority, that is board of directors. Then should the board of directors specify that what was not known on 31st March as a theft should be recorded as a theft now, and should we consider that our cash account is required to be reduced and P&L account should be debited by loss by theft account? That is the question. Think about it. Pause the video, think about it, and then come back to understand what is the answer. So what is the type of event? This is basically an adjusting event. Why? Because it's an event which is occurring after the balance sheet date. What is occurring after balance sheet date? Detection is happening after balance sheet date. Theft did not happen after balance sheet date. Detection is happening after balance sheet date, which is only helping you to understand what was the real position on balance sheet date. I'm repeating again, detection which happened after balance sheet date helped you to understand what was the real position on balance sheet date. Therefore, if the fraud of accounting period is detected after the balance sheet date but before approval of the financial statements, it is necessary to recognize the loss amounting to rupees 5 lakh and adjust the accounts of the company for the year ended 31st March 2021. It means the company must pass the entry loss by theft account debit to cash account. I hope it is clear to all of you, because it's an adjusting event. The event already took place before 31st March. It was not detected before 31st March, and after 31st March it is detected, and since the board of directors are yet to approve the financial statements, it is better for you to amend the financial statements and make the record of the particular event which took place. What was the event? Theft, which was undetected prior to 31st March, but after 31st March a new event took place. What is that? Detection, and detection told you what was the real position on 31st March, so it is better for you to adjust the same. Now next example, an earthquake destroyed a major warehouse of ACO Limited on 20th/5/2022. The accounting year of the company ended on 31st March 2022. The accounts were approved on 30th June 22. The loss from earthquake is estimated at rupees 30 lakh. State with reasons whether the loss due to earthquake is an adjusting entry or adjusting event or non-adjusting event, and how the fact of loss is to be disclosed by the company. So when the earthquake took place, it took place on 20th of May. Accounting year ended obviously on 31st March. After 31st March, 20th May, on 20th May there is earthquake, and thereafter on 30th June the books of accounts are approved. Now should you record the loss on earthquake of rupees 30 lakh in your financial statements? That's the question. Earthquake did not take place before 31st March. Earthquake took place on 20th May. So earthquake is not like the theft which took place before 31st March. In the previous example, the theft had taken place before 31st March. It was detected after 31st March. Here, as on 31st March or prior to 31st March, earthquake did not happen. Then on 20th April, earthquake happened. And obviously immediately it is detected. There is no question of any delay. The day of earthquake and the day of detection of earthquake is not different. It is the same day. And immediately you understood that there is a loss of rupees 30 lakh. Thereafter on 30th June, you are approving your board of directors are approving your accounts. The question is, should the board of directors specify the accountant, tell the accountant, instruct the accountant to make the entry of loss, P&L account debit side, loss by earthquake, and less from balance sheet asset side? Should they pass that entry? That is the question. Okay, think about it. Pause the video, think about it, create your answer, and then come back to my answer. This is which type of event? It's a non-adjusting event basically, because the event did not happen prior to 31st March. It is a non-statutory event. There is no dividend like adjustment here. It is also not affecting going concern, because they have not told you that the company's total assets are destroyed. They are saying only assets of rupees 30 lakh ka loss ho gaya hai, but loss kitna hua ascertain kar diya hai. But it is a significant event, so it is non-adjusting because it was not already something which happened prior to 31st March. And on 31st March it was never possible for you to imagine that afterwards there is going to be an earthquake. It is not like dividend that a statutory obligation is created. It is not affecting going concern because nothing is mentioned in the problem that the company has suffered major loss and it is impossible for the company to do the business hereafter. Such adjustments are not given, so it is not affecting going concern. But at the same time it is significant because damage by earthquake is something which will have to be told to the reader of financial statements. So what is the principle? Such events would normally not require disclosure in the financial statements, although they may be of such significance that they may require a disclosure in the report of the approving authority to enable the users of financial statements to make proper evaluation and decisions. So what is the treatment? Destruction of warehouse due to earthquake did not exist on the balance sheet date. Therefore, loss occurred due to earthquake is not to be recognized in the financial year of 2021-22. Considering that going concern assumption is still valid, there is no need for you to prepare financial statements on liquidation basis. The fact of earthquake together with estimated loss of 30 lakh should be disclosed, but not in the financial statement, not by way of a note to financial statement. It should be shown by way of a disclosure in the report of the approving authority for the financial year 2021-22 to enable the users of the financial statement to make proper evaluation and decisions. I hope it is clear. Not in the P&L account, not as a note to P&L account, but in the report of the board of directors. Okay, pause the video, take a break, and then come back to the next example. So here is the next example. Company has filed a legal suit against the debtor from whom 15 lakh rupees is recoverable on 31st March. So on 31st March, amount of rupees 15 lakh is recoverable, and company has already filed a case. So as on 31st March, it is already known that the case is going on. The chances of recovery by way of legal suit are not good, as per the legal opinion given by the counsel in April. In the month of April itself, the legal counsel, whoever is your lawyer, he is telling me that probably your case is not going to stand in the court of law and you may lose the claim of rupees 15 lakh. Can the company provide for the full amount of rupees 15 lakh as a provision for doubtful debt? So the debt was in existence prior to 31st March, case was in existence prior to 31st March, and before the financial statements are approved, the legal counsel has told you that probably you are not going to win the case and you may lose 15 lakh rupees. Then should the board of directors instruct the accountant to create a provision of rupees 15 lakh for the bad and doubtful debts? That's the question. So what is this? This is basically adjusting event, because the debt is doubtful is already known to you before 31st March. Therefore, to recover the debt, you have already instituted a case before 31st March. So this particular event was already there and it is already known to the company. Only thing is its outcome was not very clear. So now, in the month of April, before the financial statements are approved by the board of directors, if the counsel has given you the clarity of thought, if the counsel has given you the clear position that probably company is not going to win, it is better for you to make the adjustment in the P&L account itself by passing the entry for RDD account debit to, P&L account debit to RDD account. P&L will be debited and RDD will be credited by rupees 15 lakh. So it's an adjusting event. You can read the principle. That is the same principle I am copying again. In the given case, company should make the provision for doubtful debts as legal suit has been filed on 31st March 2021 and chances of recovery from the suit are not good. Though the actual result of the legal suit will be known in future, yet the situation of non-recovery from the debtor exists even before finalization of financial statements. Therefore, provision for doubtful debt should be made for the year ending on 31st of March to the extent of rupees 15 lakh. Next example. Take a break if you want and then come back. So let me read. In preparing the financial statements of R Limited for the year ending 31st of March 2021, you come across the following information. State with reasons how you would deal with this in financial statements. The company invested 100 lakh rupees in April 2021. So 31st March, the company has not done anything. In April 21, the company has invested rupees 100 lakh. Before the approval of financial statement by the board of directors in the acquisition of another company by doing similar business, company which is doing similar business, the negotiations for which had started during the year. So before 31st March, the negotiations took place. The purchase consideration was finalized. The discharge of purchase consideration was also finalized. But the discharge could not take place before 31st March. The discharge took place in April. Which company we are going to buy, that is decided before 31st March. At what purchase consideration we are going to buy, that is decided before 31st March. How the purchase consideration will be discharged, in which form it will be discharged, everything is decided before 31st March. But the actual discharge transaction, discharge of purchase consideration transaction, that took place in April, and thereafter the board of directors are approving the financial statement. So the question is, as on 31st March, PC is not paid. As on 31st March, 100 lakh rupees are not yet going out of our bank account. As on 31st March, the assets of another company have not yet become our assets. Although transaction took place, but payment is not yet made. And payment is made in the month of April. Then should you record the same in your balance sheet or P&L account which ended on 31st of March. So this is basically not an adjusting event, because as on 31st March, our bank account was not reduced. Although transaction negotiations took place, PC was decided, but our bank account did not get reduced. Plus this is non-statutory also. There is no compulsion like within 45 days you should pay and something of that sort. It is also not affecting going concern, but it is a significant event. Because as on 31st March, although you are finding that your bank balance in the balance sheet is maybe rupees 200 lakh, maybe 300 lakh, but then immediately in the month of April, out of that 100 lakh rupees are going to go out. So let the reader be aware that he is looking at a balance sheet which shows bank account of rupees 300 lakh, but immediately in the next month, the bank account has gone down from 300 lakh to 200 lakh. 100 lakh rupees are going to go out. Let the reader be aware of this particular situation. So in the given case, principle I am not reading, you can read it. You can pause the video, read the principle. Treatment is, in the given case, the acquisition of another company is an event occurring after the balance sheet date. However, no adjustment to the assets and liabilities is required, as the event does not affect the determination and the condition of the amounts stated in the financial statement for the year ended on 31st of March 2021. The disclosure should be made in the report of the approving authority. Be careful. This is non-adjusting, so no question of financial statement getting adjusted. This is not by way of a footnote because it is not a statutory liability, but this is by way of a disclosure in the director's report. Okay. The disclosure should be made in the report of the approving authority of those events which occurring after the balance sheet date that represent the material changes and commitments affecting the financial position of the enterprise. An investment of rupees 100 lakh in April 2021 for the acquisition of another company should be disclosed in the report of the approving authority to enable the users of financial statement to make proper evaluations and decisions. I hope it is clear to all of you. Let us consider next example. A limited company closed its accounting year on 30th June 2021. Okay, the accounting year is closed on 30th June. So their accounting year is not ending on 31st March, it is ending on 30th June. And the accounts for that period were considered and approved by the Board of Directors on 20th August. So accounting year is from 1st July to 30th June. And after 30th June on 20th August, they are approving the financial statements. The company was engaged in laying pipeline for an oil company deep beneath the earth while doing the boring work on 1st of September 2021. म्हणजे 20 ऑगस्ट नंतर 20th August, after 20th August, when they are doing the boring work, it had met a rocky surface for which it was estimated that there would be an extra cost to the tune of rupees 80 lakh. So suddenly their project cost has gone up by rupees 80 lakh. But when did you understand that particular thing? Not before 30th June, not before 20th August. You understood this thing on 1st September. 1st September is after the date of approval of Board of Directors. You are required to state with reasons how this event would be dealt with in the financial statements. Simple. This is not an event which is to be considered as event occurring after balance sheet date, because the definition of the event after balance sheet date is from the date of balance sheet to the date of approval by the Board of Directors. So from 30th June up to 20th August, if any event takes place, then it will be called as event occurring after balance sheet date, and then we will question whether it is adjusting event or non-adjusting event. The current event, although it is increasing the project cost, is taking place on 1st September, that is after 20th August. So it need not be considered as an event occurring after balance sheet date. It will have to be accounted in the next accounting year itself. So it is not an event after balance sheet date, and then the definition of event occurring after balance sheet date is given. So treatment is, in this case, the incidence which was expected to push up the cost became evident after the date of approval of the account. So it is not an event occurring after balance sheet date. Accordingly, it need not be given effect to the financial statements. Also, no disclosure is needed in the report of the approving authority, and no note to any financial statements also. So neither in the financial statement, nor in the notes, and nor in the report of the approving authority. Nowhere it is required to be disclosed. Okay. Now second last example. While preparing its final accounts for the year ending on 31st of March 2021, a company made a provision for bad debts at the rate of 5% of its total trade receivables. In the last week of February 2021, a trade receivable for rupees 2 lakh had suffered a heavy loss due to earthquake. The loss was not covered by insurance policy. That means the debtor is probably going to lose everything. In April 2021, the trade receivable became bankrupt. Can the company provide the full loss arising out of the insolvency of the trade receivable in the final accounts for the year ending on 31st March? Quite an easy question. The final accounts are ending on 31st March. Company made a provision of 5% on all debtors based on past experience. In the last week of February, that means before 31st March, the company came to know that one of the trade receivable from whom they are going to recover rupees 2 lakh has already suffered a heavy loss due to earthquake. The earthquake took place where our debtor is doing business, and he has suffered a loss of rupees 2, he has suffered a great loss. So whatever money which we are going to recover from him, which we are going to claim from him, that is rupees 2 lakh, probably we may not be in a position to recover. And in April, that is up to 31st March, he was still trying to find out the ways of paying. In February, he suffered earthquake. So in February, we were aware that this debtor of rupees 2 lakh probably may or may not pay. Up to 31st March, he did not declare anything. In April, he declared bankruptcy. So now the question is, should we continue with our usual method of creating a RDD at the rate of 5% on total debtors, or should we consider full RDD to be created on the debtor of rupees 2 lakh? That is a question. It's an adjusting event basically, because the debtor was already in existence before 31st March. The position that the debtor may not be in a position to pay is already known to us before 31st March. and before the board of directors are approving financial statements, the fact that the debtor has become insolvent is coming to our notice. That means it becomes an adjusting event. We will have to record for the same. So full provision for bad debt amounting to rupees 2 lakh should be made to cover the loss arising due to insolvency in the final accounts for the year ending 31st of March. So entry will be P&L account debit to RTD account. It is because the earthquake took place before the balance sheet date. Had the earthquake taken place after 31st March, then this would have been treated as non-adjusting event and only disclosure as per AS4 would be sufficient. So agar wo earthquake would have taken place after 31st March, then we would have said that okay, as on 31st March we were thinking that the debtor is good. It is only after 31st March that the earthquake took place. So then balance sheet is not supposed to be changed. Then it would have become non-adjusting event. Now here, since the earthquake had already taken place prior to 31st March, it becomes an adjusting event. Accordingly, the treatment is given. Next example is during the year of 2001-2002, Raj Limited was sued by competitor for rupees 15 lakh. So during the year itself, we were already sued for infringement of a trademark. So the case was already instituted against the company before 31st March. So it is known to us that the case is going on. Only the result of case is not known to us. Based on the advice of the company's legal counsel, Raj Limited provided for a sum of rupees 10 lakh in its financial statements for the year ending on 31st March. So as on 31st March, Raj Limited legal counsel has told that probably you may lose the case. It is better for you to be ready to shell out rupees 10 lakh. Accordingly, Raj Limited has already passed the entry in the books of accounts that we may have to pay for infringement of the copyright or trademark. So expenditure account debit to amount payable account, amount payable for infringement of copyright. On 18th of May 2002, the court decided in favor of the party alleging infringement, but that means the case is decided in favor of the other party and against us, and ordered Raj Limited to pay the aggrieved party a sum of rupees 14 lakh, and the court has told us that you will have to pay rupees 14 lakh. We already have provided 10 lakh. The case was of rupees 15 lakh. We had provided 10 lakh, and now the order of court has come on 18th May that we may have to pay 14 lakh. So we have made a short provision of rupees 4 lakh in short. Financial statements were prepared by the company's management on 30th April. Financial statements were prepared on 30th April. Financial statements are ending on 31st March, prepared on 30th April, but approved by the board of directors on 30th May. Date of preparation of financial statement is not important. Date of approval is important. So ignore 30th April, consider 30th May. So the order of the court has come on 18th May, which is after 30th April, but 30th April is useless for us. What is important is 30th May for us. That means the order of court has come before 30th May, that is before approval. That means it is necessary for the board of directors now to consider not only to keep the provision for rupees 10 lakh, but to increase the provision by rupees 4 lakh. It's an adjusting event. The case is already known to you, and the provision was also made, and before the board of directors are approving the financial statement, the court judgment has come. That means you can make the additional adjustment of rupees 4 lakh. Now if the court judgment would have come on 1st June, then it would have been considered as an event occurring after the approval of financial statement, and then it is not covered by AS4. Then it will be recorded in the next accounting year, not in the current accounting year. Okay. And now the last question of this topic. The financial statements of Alpha Limited for the year on 2001-2002 were approved by the board of directors on 15 July. The following information is provided. Suit against the company's advertisement was filed by the party on 20th April claiming damages of 25 lakh. So there was a case against the company, and the case was filed before 20th April, and the board of directors have approved the financial statements on 15th of July. Remember, that means the case is filed before 15 July. So it becomes what? But it was not known to us before 31st March that the case will be there. That's why it becomes which particular thing? It becomes a non-adjusting event. If the case would have been filed before 31st March, not on 20th April, but before 31st March, then we would have recorded the same. Now since the case is not before 31st March, case is after 31st March, but it is before 15th of July, it is an event occurring after balance sheet date, but it is a non-adjusting event. Therefore, it's a non-adjusting event, and the damages need not be disclosed in the balance sheet. You may record it only in the report of the board of directors. Okay. Next one is the terms and conditions for acquisition of the business of another company had been decided by March 2022. So terms are already decided by March, but only financial resources were raised in April 2002. Amount invested is rupees 50 lakh. Then what should you do? Since entire transaction is completed in March, only payment is made afterwards. Then it becomes an adjusting event. You can record the thing in the balance sheet, and effect of rupees 50 lakh for acquisition of financial transaction or financial assets should be shown in the financial transaction. Now if it would have been the case that the negotiations and everything else are also not completed before 31st March, the negotiations got completed after 31st March, then we would have said that it is a non-existing event. Okay. Last one, theft of cash of rupees 5 lakh by the cashier detected on 31st March, detected on 16 July. We have already seen such type of transaction. Since the theft took place before 31st March, that means it's an adjusting event. We will have to record it in the books of accounts. So here we are completing the accounting standard number 4 with all the different examples. I hope you have understood the accounting standard properly. In case of any difficulty, you can ask me separately in the Google Classroom or maybe in the comment section. Okay, so thank you very much. All the best. In the next lecture, I'm going to talk about accounting standard number 5. Okay, thank you. Bye bye.